Hello, and welcome to the latest Structured Finance in Focus podcast. My name is Kevin Kendra, Managing Director, Head of North American RMBS. Today I'm joined by Managing Directors Alessandro Pighi, Head of European RMBS, and Ben McCarthy, Head of Asia Pacific Structured Finance. On this episode, we'll be discussing the global housing and mortgage outlook for 2025. Let's get started. Home price growth expectations is a constant theme of this report. We expect U.S. and Canada home prices to grow modestly due to mostly supply constraints coupled with pent-up demand. These trends have persisted for the past couple of years, and we expect that to continue in 2025. Ollie, what are we expecting for home prices in Europe?
Thanks, Kevin. So in Europe, home prices will rise next year. We forecast price to rise in 6 of the 7 European countries which are covered by the Fitch Global Housing and Mortgage Outlook. Magnitude of increases vary significantly. The drivers of growth are falling mortgage rates and solid income growth and a persistent undersupply. I said that countries and growth in countries vary significantly. We have one country, France, where we still forecast a modest decline with prices to bottom out in 2025.
Thank you. And Ben, what about APAC?
It's really a mixed bag for the countries in APAC covered in this report. Australia is very similar to what you outlined for the US and Canada. Continued low unemployment, strong net immigration, and supply constraints, and then you add the expectation of interest rate cuts in 2025, that all continue to provide support for house prices. It's countered somewhat by affordability constraints, so we expect price growth to be a little lower in 2025 and then lower again in 2026 from the 5.2% growth we saw this year. In China, it remains in a severe housing downturn, and we expect home prices in China to fall a further 4 to 6% in 2025 amid the continued weak market sentiment, with the multi-year decline extending again into 2026, although it should moderate by then. There will be some variance between top-tier cities and other markets in China, but prices are already down some 16% from the peak in 2022, so peak to trough looks like it'll be down about 25%. The last market we cover in this report in APAC is Japan. And in Japan, again, interestingly, interest rates are rising in Japan for the first time in 20 years. Despite that, in the short term, we're expecting the lack of new home supply will provide a temporary support for home prices, which will likely be flat next year. But the higher mortgage rates and weak demographics will act as a drag in the longer term.
Thank you. And let's now shift over to performance. We're expecting serious delinquencies to tick up modestly in the U.S. and Canada, up from currently very low levels. One performance trend that we're following are changes to loss mitigation strategies being used by servicers. A large amount of borrower equity in the U.S. housing market currently is really resulting in very, very few liquidations where the servicers are actually foreclosing on the properties and liquidating them. We do see servicers, though, working to keep borrowers in their homes if possible, and using the deferral modifications increasingly, which will either address missed payments or potentially lower future payments for borrowers in the future to keep them in their homes. Ben, what are we expecting for performance in the APAC region?
Well, despite our sort of varied outlook for house prices, the performance on mortgages are actually looking to be pretty stable across the region. In Australia, interest rates are expected to start to fall in 2025, and with that, serviceability will improve. And in the market where almost 100% of mortgages are on variable rates, that's likely to help performance. So we're actually expecting performance to slightly improve. In China, we expect more mortgage rate cuts, which will enhance serviceability. And they have high household savings in China and loan to valuation ratios, which again is going to make that likely be very stable in 2025. In Japan, we've got, as I say, higher rates and higher cost of living. So slightly going the other way. So we expect a mild deterioration in arrears in Japan, but nothing too significant.
Great. And then, Ale, what about Europe? What are we seeing for performance or expecting performance to be for European RMBS?
As you guys have just said, I think our forecast is similar. Stable arrears for the EU, the Eurozone countries, just for the same reason. So strong income growth, fairly low unemployment, and rates are still decreasing. Whilst in the UK, similar pictures, but we expect a small uptick in later years next year, as a number of borrowers still have to refix, and they're still on very low rates, so they still have to bear the brunt of higher rates, although these current rates are not as high as they were 2 years ago. And for those borrowers that are underperforming, the same strategy that you mentioned for the US, Kevin, will be very much at the forefront of servicing strategy. Forbearance is the key word in most of the European jurisdictions. So we foresee very limited use of repossessions and liquidations.
Thank you. And so the last topic I really want to delve into is what should we be watching for in 2025? Leila, we're going to start with you this time. And what are you looking at for Europe?
Yeah, so in terms of what to watch, I think inflation from kind of a economic background is the key risk. So we've been seeing stabilization of inflation in the Eurozone and in the UK, but lately we have witnessed a bit of uptick on inflation measures in both areas. If inflations were to persist and increase materially, perhaps due to geopolitical risks that would affect supply chain, or perhaps due to fiscal policies that, like the UK budget is inherently inflationary, could have a drag effect on higher mortgage rates and therefore limiting demand, and therefore perhaps also putting a little bit of concern on mortgage performance. Another big topic that we are watching closely, although in Europe the impact of it is still to be seen, is the theme of energy performance and physical risk. The EU is at the forefront on the, say, battle for home improvement. So EPC, energy performance certificates, are the measure for this risk, and we've seen already some bifurcation in the market. So assets are the benefit from very strong EPC are appreciating much more than the average, whilst those that are at the bottom of the EPC scale tend to be left out with limited demand. Having said that, we see different countries traveling at different speed. So in the north of Europe, there's certainly a focus, so lenders are offering different rates as a function of the EPC of the property. Other countries are a bit more kind of slow moving, but certainly it's a topic that we're watching closely. And clearly physical risk and perhaps the cost of insuring physical risk in Europe is increasing, not perhaps as much as in other places in other parts of the world, but we've seen floods, we've seen material natural disasters in areas that were in the past not prone to them.
Thank you. And Ben, what are you expecting, or what are you watching for in APAC?
In APAC, there are, I guess, two big items to watch. Interest rates and unemployment are always two sort of key variables. In Australia, interest rate cuts have been expected for the past year, or at least discussed for the past year, but the economic fundamentals haven't really justified a rate cut. So we've still got unemployment at close enough to all-time lows, around 4.1%. Mortgage performance is good. House prices are still rising. Consumption's growing. None of that seems to indicate that interest rates should be cut. And at the same time, we have savings rates that are close to zero. So there are people hurting out there, and if interest rate cuts don't come, we do expect to see some change in performance. So I'd say to watch some of those economic variables, particularly unemployment and interest rates, are sort of the key things there. In China, they've launched a whole range of stimulus packages to stimulate the market. So it's key to see how they implement them and what the impact is going forward. While in Japan, rising rates is something new there. They haven't had them for more than 20 years. So that'll be something to watch in that market.
Right. And then for the U.S., we're preparing for housing policy changes that would come with a change in the presidential administration. The previous Trump administration made efforts to shrink the role of government in the housing market by really taking strides to release Fannie and Freddie from conservatorship. We'll have to wait and see if he continues on that trend in his next term. Similar to Ale, the U.S. also is dealing with affordability issues relating to increased fixed costs that are coming from insurance premiums, as insurance premiums are rising for climate change risk, and along with increased tax assessments that we're seeing. So taxes and insurance are having an impact on affordability. And lastly, we look at what's going on global geopolitical and macroeconomic uncertainty. That's really having an impact on the 10-year Treasury yields, keeping them elevated slightly high. That impacts 30-year mortgage rates, and really that will be the triggering event for refinance activity. So if mortgage rates drop below 6%, then we're expecting that to fuel higher levels of refinancing from recent mortgage originations. So those are all some of the things that we're really looking at within the U.S. Well, that's our time for today. I want to thank Ben and Ale for their insights, and thank you all for listening. For more information on Fitch's global housing and mortgage outlook for 2025, please visit our website, fitchratings.com.